Hi, welcome back to another Econ Podcast with Mr. Hagan. On this Econ Podcast, we're going to talk about different retirement accounts. I just want to emphasize that this video is not designed to give investment advice or tax advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about retirement accounts. If you want investment advice or tax advice, please see a professional. All right, so let's go back to talking about traditional IRAs. So in a previous video, I talked about traditional IRAs, and I talked about the different limitations that are placed on you by the government if you decide to declare your investment as a traditional IRA. So for example, you get a tax deduction on the contributions if you do this. You are limited to putting in $6,500 per year. The money grows at the full total return. You get tax deferred growth. You don't have to pay capital gains and dividends as it grows. You can take the money out when you're 59 and a half. You have to pay income taxes on it when you withdraw it. And you can invest in any stock or mutual fund that you want to. So we want to look at a math example of this. And to do that, we have to look at our 3 steps down here. We're going to do 3 things. We're going to calculate the amount of our tax deduction. We're going to look at how your contributions grow over time at the full total return, tax deferred growth, no dividends or capital gains taxes to pay. And so we'll use our formula, P times 1 plus R to the T, to do that. And then finally, we'll calculate how much we actually get to keep. Okay? And keep in mind that when we withdraw the money, we're going to have to pay income taxes on that money. So we're going to take the answer from up here from step 2, and we're going to multiply that by 1 minus the income tax rate at retirement. Okay, so let's get to an example, then that'll help you understand what I'm talking about. So let's say that we have this situation. Let's say that dad puts $5,000 in some family. Dad puts $5,000 into his traditional IRA. He's allowed to do that because in 2020, that was capped at $6,500. Mom puts $5,000 into her IRA, which she is also allowed to do, assuming they meet the income requirements. Let's assume they get a total return of 10% per year. They face an investment tax rate of 15%, and that their income tax rate is 25% now and when they retire. And then finally, they're going to withdraw this money in 30 years. Okay, so we want to figure out how much money will they have at the end of those 30 years when they withdraw the money. Now, these accounts, I need to say clearly, mom and dad's IRAs are separated by law. These are 2 separate accounts. Dad has his IRA. It's an individual retirement account. Mom has her IRA. It's an individual retirement account. Okay, these are not the same accounts. They are 2 separate accounts. However, we can treat them, we can put them together for the purposes of doing the math on this. Okay, so I'm going to say that mom and dad together put in $10,000 into their traditional IRA, and let's say that they did this through a company like Vanguard. There's a lot of others, Fidelity, and many other companies. I'm just using Vanguard as my example because they're a big no-load mutual fund company. So they put the money into Vanguard's S&P 500 fund. Okay, let's say that they do that. So how are we going to do these calculations? Well, let's go back here. Step number 1 is we want to calculate the tax deduction. All right, so we do that by taking the contribution times the income tax rate. So mom and dad put $10,000 into this account. Dad put in 5 into his, mom put 5 into hers. Okay, now over here, I'm going to calculate the income tax deduction, which is their contribution. That was the $10,000 multiplied by their tax rate of 0.25, multiplied by the tax rate of 0.25. So let me just say that again. That's the contribution 10,000 times your income tax rate of 25%. And by the way, why am I doing the calculation this way? Because this $10,000, I was going to have to pay 25% income taxes on that. But now I don't. Okay, now I don't have to pay taxes on that $10,000. So that's going to give me a tax savings of $2,500. That's going to give me a tax savings of $2,500. $500. That's just an extra $2,500 that's in my pocket. Okay, done. Now, let's actually get into doing the investment calculation. So now we're going to be looking at steps 2 and 3. Okay, I'm going to get my full total return, my P times 1 plus R to the T. I'm going to get my full total return on this money. It's not, there's going to be no dividends and capital gains taxes on it as it grows. So we're not going to use the after-tax total return that I used in the personal account video. We're going to get the full total return. So we're going to get the full total return, which in this example is 10%. Okay, so the money's going to grow at 10%. So all I'm going to do here is I'm going to take, this is step number 2. So over here, this was step number 1. I should have labeled that. Over here is step number 2. So step number 2, I'm going to get the full $10,000, $5,000 in my account, in Dad's account, $5,000 in Mom's account, times 1.10. That's my full 10% total return, raised to the number of years, which is 30 years, raised to the 30 years. So I'm going to pull my calculator out, and I'm going to do that calculation. So that's going to turn into 10,000 times 1.1 raised to the 30th. That's going to turn into, according to my calculations, that's going to turn into 174,000. It's going to grow into $174,494.02. So that's how much money I will have at the end of 30 years. Actually, some of that will be in Dad's account, some of it will be in Mom's account, but this is the total together, how much they will have. Now, step number 3, they don't get to keep all of that, because when you take the money out, you have to pay income taxes. So we got to take our answer to step number 2 and multiply that by 1 minus the income tax rate at retirement. Okay, let's talk about why that is. So step number 3 is I'm going to take this $174,494.02. I'm going to multiply that by 1 minus my income tax rate, which is 25% at retirement. So times 1 minus 0.25. Now, why am I doing it this way? Well, because what this really means is, what I'm really doing is I'm taking this $174,494.02 times 1 minus 0.25 is what I get to keep. The government's going to take 25%. Okay, that means I'm going to get to keep the other 75%. Okay, I'm going to keep 75%. So let's do that calculation. So I take $174,494.02 times 0.25. That's 1 minus 0.25. And I get a final answer of $130,870.52. I just rounded that up. And 52 cents. Okay? That's what I actually get, or Mom and Dad together. That's what they actually get to keep. And that should be my answer down here. And there it is. Okay, that's what they actually get to keep. That's their final answer when they withdraw this money at the end of 30 years. So let's compare that to the personal account. Okay, let's compare that to the personal account. In the video where I did this calculation with a personal account, this is what it looked like. You can go back and watch this video. But at the end of 30 years, let's focus on this. At the end of 30 years, if you put $10,000 into a personal account and pay all the taxes along the way, you would end up with $115,582.52. That's what you end up with. If you put this money instead, that $10,000, if it's put in traditional IRAs instead, it's going to grow to $130,870.52. That's $15,000 more dollars that you have in your pocket simply by calling this a traditional IRA. Plus, don't forget, you also got this tax benefit over here right now today of $2,500 in your pocket. Okay, so let's just do that comparison again. The $10,000, if you put it into a personal account, you'll have $115,000 30 years from now. If you put it into a traditional IRA, you'll have $130,000 15 years from now, plus $2,500 today. Okay, so now you could ask the question, well, why doesn't everybody just then put the money into the traditional IRA? Why doesn't everybody do that? Why would anybody put it into a personal account? Well, remember, you can't touch this money until you're 59 and a half years old. Okay, so if you need the money before then the traditional IRA isn't going to work for you. Okay, so that's the limitation that you face. That's the trade-off that you face. All right, this has been Mr. Hagan on another Econ podcast talking about retirement accounts. Thanks for joining us, and we'll see you on the next Econ podcast.